Hello, my name is Mark Helm, and I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Self-Storage Quick Start Academy. And I support small investors who are getting in the self-storage business and small investors who want to grow their self-storage business, strategically purchase self-storage in a way that creates true wealth and a fulfilling career. And that strategically purchasing self-storage has never been harder than it is right now. And prices are extremely high. If you've been out trying to buy self-storage, you know exactly what I'm talking about. But you can still purchase even in a seller's market, even in an overpriced market, if you know what you're looking for and you know how to analyze it. And that's what this series of episodes called How to Analyze Self-Storage in Today's Market is all about. And what we look for, this is the second in a series. If you didn't watch last week's, go back and watch it. But what we look for today, in today's market, for the most part, are value-added self-storage opportunities. Why? Because we cannot purchase a stabilized, the small investor has a hard time purchasing a stabilized self-storage facility at anywhere near the prices that they're listed at today and still get the returns that they need for their business strategies. So what we have to do, the smaller investor, we have to find properties that have opportunities to create more value. Yes, we're probably going to pay more than we want for what's there, but if we're confident in what we can add to it and how much we can add, we can still get in the self-storage business and get the returns that we need, even in today's market. So the game is look for the value-added opportunities. Now here's the good news. Even with all of the large players out there, even with the Extra Spaces, the CubeSmarts, the big players, still over 60% of all self-storage facilities in our country are owned by people who own just one facility. That's amazing. Over 60% are owned by someone who owns just one facility. We call them the mom and pops. They, think about it, over the next decade, what percentage of those 60% are probably going to go on the market, go through a generational change, go through a life circumstance change? A lot of them. There are value-added opportunities everywhere. One of the things that we have found out is that when we buy one of these properties, what we find is that the owners, for the most part, get very complacent with their existing cash flow and don't want to do anything to rock the boat, and they leave lots of money on the table. So one of the things that we look for is facilities with high accounts receivable. That tells us that perhaps they're not doing as well on their management practices as we will do in collecting the money. We love it when we find a facility that has a high physical occupancy and a much lower economic occupancy. That tells us the same thing. Even in today's market, when our company's buying expansions, we on average get between 8 and 10% more income just by tightening up the management practices before we ever put the first new unit into production. Now, this is not an episode on management practices. We have those. Go to creatingwealththroughselfstorage.com, and there's all types of episodes and series on good self-storage management practices. But what we want to talk about today is how to find the value-added properties. Well, basically, there's 4 types of properties you can buy today in today's self-storage market. Type number 1 is an existing facility. We'll talk about how to generate the income and analyze the income on that. Type number 2 is an expansion. It's an existing facility with additional land that you can add more units to, or perhaps a parcel of land next door that you can add more units to. But that is an expansion. Also look for opportunities to have a lot of parking. Perhaps you could take some of that parking out of service and put more self-storage on there. The third type of opportunity is conversions, where you take an empty building and repurpose it for self-storage. And the fourth type is new construction with raw land. Now, let's talk about existing self-storage facilities. This is where everyone has the problem. These are very overpriced, but they're a good place to start. So if you can start getting confident in figuring out what you can pay for existing self-storage facilities, that will begin to train and help you as we go to the other types of properties. Well, let's look at how you generate the income numbers on all these different types of properties. Being able to analyze in today's market is a critical skill. It used to be you'd come up with a net operating income and plug a cap rate against it, and that's what you'd pay. Or you would run a real rough number, square feet, 35% operating expenses. This is the NOI, this is what it's going to be worth. Those days are gone. You have to know precisely what the cash flows are going to be so you can back into a price that you can pay in today's market. And I'm not talking about just buying to get into business. I'm talking about getting into business in a very strategic way that creates real wealth, true wealth for you and your family. So let's begin to look. The first part of the analysis in self-storage is generating income. Now, self-storage is very unique from any other type of commercial real estate investment play. In every other type of commercial real estate, income is generated with a rent roll. You take a rent roll of the spaces or the tenants, what the lease rate is, the lease term is, and you generate the income off that. You can't do that in self-storage. I mean, we have facilities that have over 1,000 units that change daily. Now, in self-storage, you've got to either use a unit mix page or figure out what's the income per square feet and how many square feet you can construct. So let's start. Let's look at an existing facility. When you are looking at an existing facility, that's a facility that's already there and operating, and 9 times out of 10 in the listing package, there's going to be a unit mix page like this. Well, this is a typical unit mix page that we'll find in a listing package. In fact, this came out of one that I'm currently analyzing right now. And what we look for is the unit sizes that are in the facility, how many of them there are, what the street rate is, and sometimes these will even tell you how many are occupied and how many are unoccupied. You need this to start doing the analysis on existing self-storage so you can get what the gross potential income is for that particular facility. Then you enter that in your program. We use the Storage World Analyzer because it's very easy to use. I'm going to show it to you in just a second. But you can also use Excel spreadsheets. You can use a number of things. But what I found is most people are either using Excel or they're using Storage World Analyzer because I can't find many other programs out there at all that deal with self-storage. Well, let's take a quick look at what it looks like as we enter the unit mix. Now we're using the Storage World Analyzer, and we're also going to look at some in Excel, but right now let's call this episode 104, and this is an existing facility, and let's start. So how it looks is you just take the unit mix page that the seller's given you or the agent's given you, and you start entering it. So the first one was a climate controlled. It was a 4x6, and it looked like they had 24 of them, unusual size, and they were charging $70 a unit. Then the next one was a climate controlled 5x5. They had 25 of them, and they were charging $75. I'm going to fill this out so you don't have to watch. I'll be back in just a second because it can get kind of boring. So as we enter the unit mix here, whether you're using an Excel spreadsheet or a financial analysis program, you can see it's a big facility, 71,227 square feet. We have over $742,000 a year in projected income. Something to think through as you do this is what other type of income sources will you have? So on this one, for example, we'll probably have a full-time manager and an office. So we'll be selling some retail items. I'm projecting maybe $300 a month, pretty conservative. And truck rental, I'll ultimately call a truck rental company, see what you can generate in income, but $650. So this is what it takes. The gross potential income for the unit mix page, it was in the package that's in the blog, episode 104, is $742,368. It's that simple. When we're done, this is what the printout looks like. Now here's a printout from another facility we're looking at, and what you see is that you want to separate the climate control, non-climate control, and parking, get information on all of them, plus your total information. Now, here's the thing. You now have the gross potential income of that facility, the GPI, gross potential income. In that facility, if every unit was rented and every unit was paying, this is the maximum amount of money that could go into the bank today on your pricing. Gross potential income. Now, against that, we will start either using lease up or stabilized occupancy. Now, stabilized occupancy is once the facility is leased up, or if it's stabilized, what is the average occupancy per year? Some months will be higher, some months will be lower, but what's the average occupancy? Ultimately, your feasibility report is going to tell you that. But for now, what we do is we'll either use 85 or maybe 88% in a larger markup, but I still keep it there. Even if the seller's 93% occupied, I don't know that we're going to keep it at that stabilized rate long term. So I'm very conservative. I'll use 85, 88% stabilized occupancy. Now, here's the thing. You now have the gross potential income of an existing self-storage facility. Now let's talk about the next type of opportunity, the expansion. We love expansions. We like them because you start getting income from day one. 9 times out of 10, there is no negative income. You start being able to cover your entire overhead from day one, and you can add extra units at a lower price than you purchased the existing units for, and when you combine the two, you get a good return. Not a home run in most cases, but a good return that will help you fulfill on your business strategy. But how do you know what the additional land is going to generate in income? Well, let me give you some benchmark numbers. And if you're watching this anywhere else but on creatingwealththroughselfstorage.com, go to creatingwealthselfstorage.com, blog 104, and print that out, and all of this is there. 43,560. That's how many square feet are in an acre. So if you're looking at a facility that has expansion room, the very first thing you do is you enter, just like you did on the existing facility, enter the current unit mix, just like we did a second ago. Enter that current unit mix. Then figure out, guess, measure, come up with an estimate if you don't know exactly what is the amount of expansion land you have, and then multiply that times 43,560. If it's 0.67 acres, it's 0.7 times that number. If it's 3.5, it's 3.5 times 43,560. That gives you the gross square footage of land that you can build self-storage on. Now, most self-storage is single story, suburban style self-storage with roll-up doors, or maybe climate control building or two in it. What we use for an average on that is 33% efficiency. So in other words, on an acre of land, if it was 1 acre, 43,560, you multiply that times 0.33, and that number, that 14,375, is the net rentable income producing square feet on average that you can get on an acre of land. So we use a 33% efficiency rate at this stage of the analysis. Ultimately, either an architect or a self-storage fabricator is going to lay out an exact plan and you'll get a unit mix. But for now, we have found that 33% is a good average. Sometimes it's more, sometimes it's less, depending on the land, but that is a good average. That's about 14,375 to 14,500. That's how many net rentable square feet we average per acre of land. So figure out how many square feet of self-storage you can get on that expansion land. Then, this is kind of up to you, but look at it, determine how much of that do you want climate control, if any, and how much is non-climate control. On average, about 35% of all facilities, of all units, are climate control, on average. I have some that are 100%, we have some that have zero climate control. But look at the existing, what's the average? Does the market like it? Does the market need it? You'll intuitively know. Ultimately, again, your feasibility report will tell you, but you want to determine out of the net rentable square feet that I can add, what percent will be climate control, what percent will be non-climate control. Then go back to your unit mix page for the existing space. What is the income per square foot for non-climate control you're currently getting? What is the income per square foot for climate control? And then just multiply that times your net rentable square feet. Add that to the unit mix page and you have the gross potential income for the entire project, the existing and your expansion. Now that's not that complicated. You can do that. You will apply, we'll show you next week how that new square footage income is going to come in, and you'll have a stabilized occupancy against it, but right now you know how to calculate the gross potential income for an expansion project. Now the third type of opportunity today that we like, I find that expansions are probably the best for newer people getting in the business today. But another good one that we like are conversions. And the reason we like conversions are that you can start generating income a lot quicker than you can on new construction. And in essence, you're recycling a building. So we look for older buildings that look more industrial, large floor plates, but as much in a retail environment as we can find. And what we do is we convert those buildings from their former use into self-storage. Typically, those are mostly 100% climate control, although you can have non-climate control if there's additional land with it, or maybe on the outsides of the buildings. But for the most part, our conversions have been 100% climate control. And we like those, especially if you can add a story or two. Now, we find, depending on whatever storage system you're using, you need a minimum of 8 to 9 feet per floor. So if possible, try to find a building where you can add at least 2 floors. And here's how we calculate the gross potential income of a conversion. So we look at the floor plate. What is the size of the area of floor that we can construct on. So let's say it's 200 by 400. That's an 80,000 square foot floor plate. And let's say that we can go 2 stories high. So what the number we use, remember we use 33% efficiency against an acre of land. When you're doing conversions, we use 75%. So in other words, of that 80,000 square foot floor plate, I am going to get on average 75% of that floor plate generating income, in other words units. The rest is loading areas, hallways, restrooms, common areas. So 0.75 times 80,000, 60,000. So in other words, on that floor plate of 80,000, I'm going to have 60,000 square feet generating income. And if I'm going 2 floors, that's 120,000 square feet. Now I might phase it in, I might not build it all at once. Again, the feasibility report will tell you if there's demand for that, but you want to figure out what is the gross potential size you can build there. Now, there is no existing income, so how do you figure it out? Well, what we do is we go to the closest competitors. I try to get their prices. And I try to get a price on a 5x5. I'll go to the facility, I'll go to their website, I'll get 2 or 3 of my closest competitors. And again, this isn't an exact science at this point. We're doing a pro forma. We're trying to lay something out to see if it's worth exploring further. So I'll get their 5x5 and a price, 10x10 and a price, and get as much as I can. Then I add all the gross square footage up, and again go to episode 104 and look at the chart on how we do this. But a 5x5 is 25 square feet, a 10x10 is 100. So I total all of that up and come up with a number. Then I total all the rents up, come up with a number, and then I divide them, and I can come up with a per square foot number for my competitors. And then I just average that number. And then that's the number I would apply against the 120,000 to come up with the gross potential income. It's not that complicated. So you now know how to figure out the gross potential income of an existing facility, of an expansion facility, and on a conversion facility. I'll show you next week how you can calculate how that income starts coming in and how long it takes to get to stabilized occupancy. But just get present to, you know how to calculate gross potential income. That's a big deal. Now, the last opportunity, and it's a very valid one, it's not for the faint of heart, because we find in new construction, sometimes we go 2 to 3 years with negative cash flow, because our break-even point is anywhere from 55 to 65%. And if you're building a big facility, it could take 2 to 3 years to get to the break-even point. But our returns typically are higher on new construction. So in our acquisition strategy, we try to balance it. We try to have a balance between new construction, expansions, and conversions. That way we spread our risk over different types of acquisition types, and by the time we blend all those returns together, it's a pretty good return. If you're just starting, unless you have a lot of construction experience or have a partner who does or a friend who does, I highly recommend not being this be the first thing you jump into, although I know many people who have done it this way and are very successful at it. But it's very similar to the expansion and the conversion. The first thing we do is we get the size of the land. How big is the land in square feet? If it's 3.5 acres, that's 3.5 times 43,560. Then the next thing we do is we get what we think we're going to be able to get in rent. So do the same thing you did in the conversion. Go to your competitors, lay your chart out, go back to episode 104, look at the chart in the conversion section. We do that exact same drill in new construction. We come up with what the estimated rent is. And again, remember, ultimately, the feasibility report will tell you what you can expect in rent, but it probably will be very close to that number that you calculate from your competition. Why? Because that's your market area. That's where you get that. That's where they're going to get that information. So you apply that average per square foot rent number times how many net rentable square feet you can construct on this land size that you have, and that gives you your gross potential income for a new construction project. We'll go deeper into the analysis, ultimately talking about how you can figure out what you can pay, but everything in the self-storage world analysis starts here. Now, you now know how to calculate the income for existing facilities, expansions, conversions, and new construction. You know more than most people. You know more than most people even in the self-storage business right now. Come back. If you did not come to this episode with a project in mind to start analyzing, definitely have one when you come back. And come back having created and determined what the gross potential income is for that particular opportunity. I know I've gone fast, but Printout 104 or rewatch this again. When you come here next week, make sure you know off the top of your head how to generate the gross potential income for all the different types of self-storage opportunities that are out there. And I'm telling you, it is a good time to get in the self-storage business. The future looks bright, even though it's a high seller's market right now. The sooner you get in, the more wealth you're going to create. But do it intelligently. Don't just make an offer hoping it's a good deal. Make an offer knowing exactly what you think your return's going to be based on your analysis skills. And that's what we're learning here. I will see you next week. And thank you very much. My name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Storage World Analyzer, which you saw in this video. If you're seeing this before April 2017, that was a snapshot of version 2 that's coming out. So thank you very much, and I will see you next week.